The company was founded in 1994 and is based in Shah Alam, Malaysia. It has placed a role within the healthcare industry as a provider of quality products and services, listed on the main board of Bursa Malaysia and having established itself as a leader in the local market. Pharmaniaga Berhad is an investment holding company, operates as an integrated pharmaceutical company in Malaysia, Indonesia and internationally. The company operates through three segments, which is logistics, distribution and manufacturing. It is involved in the distribution, trading and marketing of pharmaceutical and medical products, installation of medical and hospital equipment, wholesaling of consumer products. The company also manufactures and sells generic drugs, conduct research and development of pharmaceutical products, research and manufacture collagen medical device for wound management application and sell food supplement. In addition, Pharmaniaga Berhad has great knowledge and mature ability of technique to conduct their business, such as efficient logistics system. Because of its position as a market leader in the pharmaceutical industry, this skill and experience may be able to assist the company in improving its operational performance. Pharmaniaga is also able to control their production through integration, reducing product shortage and meeting the needs of various levels of consumers. Firstly, we're going to look on liquidity ratio for Pharmaniaga Berhad. So overall, from this chart in liquidity ratio, it shows a poor performance in meeting short-term obligation because the value of current and quick ratio is less than 1 indicator base, while value of the net working capital is negative. It can be said that Pharmaniaga Berhad has lower current ratio and quick ratio, which is not capable for paying its obligation because it has a lower proportion of short-term asset value relative to the value of its short-term liabilities. So although Pharmaniaga Berhad showed the uptrend in the net working capital, but the value of the net working capital for Pharmaniaga is still negative, which means the company current asset does not exceed its current liability. Then it may have trouble growing or paying back creditors.
First is inventory turnover. For 2016, the inventory turnover of Pharmaniaga Berhad is 4.14 times. However, in the inventory turnover are decreasing for 2020 at 3.47 times. From the bar chart, we can conclude that year 2017 is better because the higher the ratio, the efficient the company managing its inventory. Next is total asset turnover. The total asset turnover of Pharmaniaga Berhad are decreasing from year 2017, which is 1.72 times, to 2020, which is 1.30 times. It shows that the company is not efficient using its asset to generate sales. Lastly is average collection period. The company take 38 days in year 2016 and 42 days in year 2020, where it takes longer period than 2016. The shorter the period is better for the company.
From the debt ratio chart, we can see there was a very small percentage increase of 77.54 to 77.58 in 2016 until 2017. Then, the decline occurred starting in 2018 to 2019 but increased slightly in 2020. However, this shows that Pharmaniaga managed to reduce debt in a higher percentage than the increase in debt in 5 years ago. Next, the debt equity ratio. In 2016 to 2017, the percentage increased significantly, causing Pharmaniaga to bear a burden debt in excess of equity. However, Pharmaniaga bounced back in 2019 and 2020 with better debt management than ever before, and finally recorded a consistent decline for 2 consecutive years. Time interest earned. In 2017, it showed a very drastic decline to reach a negative value, but Pharmaniaga did not let it continue for a long time. The percentage is in 2020 decreased compared to 2019, which may have happened due to the COVID-19 situation that just hit Malaysia at that time. To conclude, Pharmaniaga Berhad has higher dependency on debt as a resource of fund.
Operating profit margin of this company have been increasing from negative 6.85% to 3.24% in 2020. This shows that the company's activity running smoothly and the income keeps the company afloat. Meanwhile, the net profit margin of Pharmaniaga Berhad are declining from year 2017, which is 8.56% to 2% in 2020. The higher the profit margin is probably best to a lower profit margin since it indicates that the company can convert more of its sales to profit at the end of period. The company also have been decreasing for return on assets from 50.70% in 2017 to 2.60% in 2020. This shows that the company performed poor to utilize its assets. The higher the return, the more productive and efficient management of financial resources.
For market ratio, the EPS ratio has increased from 2016 to 2017 because the increase of net profit of commercial in that year. The unit price ratio had decreased from previous year. It is made due to unusual event. We can say that the money that Pharmaniaga Berhad made per share of stock issued was low. It was also a signal that the market was less stable or sustainable. The ratio increased from 2019 until 2020 up to 10.51%, which is quite high. It shows that Pharmaniaga is profitable and its stock price is likely to continue increasing. For price-earning ratio, we can see that the value for the PER, there is a huge gap between 2018 until 2019. In 2020, the market went up and the investor willing to pay 45 ringgit 28 cents per share to receive 1 ringgit of Pharmaniaga's earning. The last one is for dividend yield. We can see that from 2016 until 2018, it shows that Pharmaniaga Berhad has paid out in dividend over the course of these 3 years at the same rate. However, the percentage dropped in 2019. This situation means that the investor earned only 1.88% on the investment in the form of dividend when they bought the Pharmaniaga's common share at current market price. The decrease in dividend yield also happened in 2020. It was because when the dividend is not raised or lower, so the yield fall when the price of the stock raised. From the PE ratio, the stock price is considered overvalued.
In conclusion, the Pharmaniaga are less stable prestations, so a restructuring of strategy need to be done in management to stabilize its performance in the future and need to increase asset and reduce debt to strengthen the company's position. Therefore, the company performed poorly, but the performance started to improve in 2020 as Pharmaniaga became a supplier of medical goods for society and hospital use due to COVID-19 outbreak. COVID-19 has hit the world and Malaysia is one of the countries affected by this epidemic. So, Pharmaniaga can arrange any strategy to help the government address the problem by providing various medical equipment and vaccines to the people. The income will increase and the investor will also be interested to buy the share from this company and to jointly contribute to the country. It showed the good performance of Pharmaniaga in 2020 so that the investment activity are recommended for the local and foreign investor.